Good morning, everyone. Joe Mass here. Hey, I want to give you a quick market update. I apologize for not getting you one sooner. We've been in a major rebalance mode. We just rebalanced all of the portfolios here recently, and we've been in deep research mode. And then additionally, not much has changed since we gave you the last market update, unfortunately. I will briefly go over the factors that are moving the market and our thoughts. I'm going to spare you the 30 or 40 pages of graphs this time because, again, most things are in front of us and the data hasn't changed that much. So you've all seen this chart before, and I really want to talk about it again because it's still the major theme for us this year. You know, there's two sides of that investment coin. It's really hard to be on heads and tails at the same time. We all know if we flip a coin 100 times, it's going to land, 50% on heads and 50% on tails. And so we know investors want no risk and all the return. We understand that, and we want you to understand that it's about impossible to do that, and especially in this environment. So there's really two types of investors. There's the investors that are really wanting risk off because they're worried about the macro and geopolitical risks. And again, remember, for those people, we would need to use cash, bonds, risk off assets. However, bonds are not a good diversifier right now to equities. They're down just about as much as equities because inflation's high. Because inflation's high, cash is providing negative real returns, and risk-off assets that typically have lower expected returns are also in the area of real negative returns due to inflation. On the other side of the coin, there's the crowd that is really worried about fighting inflation, and so you have to use risk on assets to fight inflation. So that's again going to be equities and value and energy and commodities and different strategies that seek risk. The problem there is that the markets, because of the geopolitical risk, there's only a couple asset classes that are up all year. Basically, everything's down. And so it's just a year where there's a lot of convergence amongst asset classes where historically we would have a diversifying effect. Okay, so it's just a difficult year. We just have to be patient. And so it's really hard to hedge the portfolio right now. But that's what we're trying to do. And I'll talk about some of the things that we've done recently to hedge the portfolios. You've seen these slides before, but let's talk about what's driving the market. So inflation, interest rates, and corporate earnings are the three primary things that the markets are paying attention to. And right now, as we all know, it's inflation is the top of that list. The Federal Reserve and their actions are obviously impacting the market. And then, of course, the geopolitical risks. So, with inflation, it's been high both from the PCE and the CPI. We all know that, nothing new. It's maybe starting to come down a little bit, and the bond market and the futures market really believe that inflation is going to be down, quite low next year in the middle of 2023. Typically, the bond market's smarter than the equity market, but right now the equity markets are not believing the bond markets. So there's a little disconnect between the equities and the fixed income markets. The University of Michigan's inflation numbers are probably long-term in about the 5% range. So it's not going to stay at 8 or 9%. We do expect it to come down. It's just really how fast will it come down? There's arguments to be made that some of the commodity prices have come down and will continue to come down, and that's where inflation comes from. So that's good. But again, the supply chains and the geopolitical risk around the world that are also impacting inflation are not going to subside overnight. Okay, the interest rate on the 10-year bond has been going up and down. It's back up to about, just mid threes right now. It got down to mid twos, so it's been oscillating back and forth. But when interest rates have come up a little bit, that's good for people that want to buy bonds because you're going to get a higher yield. Okay. And again, remember, we prefer individual bonds right now because we can hold those to maturity and eliminate some of that interest rate risk. Corporate earnings have come down, but they're still okay. So again, we're still watching to see if earnings are going to be revised downward. Europe and the rest of the world is in a worse position than the U.S. is with inflation and earnings. So again, we're not out of the woods yet, and the markets, they recovered well in July, and then they've backed off again. So again, a lot of oscillation in between signals, a lot of whipsaw in the markets right now. And so Inflation, interest rates, and corporate earnings are still the three things that we're predominantly looking at. The Fed has said they're going to continue to be aggressive, and that's why the market sold off here recently. I'm okay with that. I'd like the rates to get back up to a normalized rate, but the Fed isn't done yet. And so we're just going to have to wait for them to get done. Remember, the market's always forward looking. It's looking 12 to 18 to 24 months into the future. And so equity markets probably won't really start a strong recovery, a sustainable recovery, until the market believes that the Fed is done or close to done raising rates and that inflation is ready to come back down. Now, the Fed doesn't have to be done and rates don't have to be low before the markets can resume an upward trend because they're forward looking. But we're not going to see a strong move upward until the market believes that. And I don't think we're quite there yet. Okay, so again, the market's looking forward, and inflation doesn't have to get back down to the 2% where the Fed wants it before the market will rally. The market will anticipate that. So we still probably have a little ways to go. Obviously the markets don't like uncertainty. The geopolitical events, the war, COVID, all of those things still remain. Technical indicators have turned bullish a few weeks ago, but then they're starting to turn bearish again, so they're really back and forth. Stock fundamentals are okay, but if a stronger definition of a recession raises its head, there's still downside risk. And then the war, the path forward remains uncertain, and of course China and the elections are out there as well. So plenty of things for the markets to be worried about. What we've done lately is increased some cash, and then we've decreased some cash. We've shorted the market. We've reduced the short. So we're really trying to manage appropriately through this cycle with the data that we get. And we're pretty happy with how all the portfolios are performing this year, given what we're dealing with. What we're going to do about that is really maintain, some patience and just continue to manage our processes. What should you do? Well, again, you've seen this before. You need to hold enough cash to make you comfortable so that you can let your at-risk money ride through. So I don't know what the right amount is. It could be 6 months, it could be 3 months, it could be 2 years, but you need to have enough cash that you're comfortable letting your portfolio do what it's supposed to do. You want to always evaluate your time horizon and other factors in your investment policy statement. Again, if you need your money in the next 3 to 5 months, the way you invest is totally different than if you need your money in 3 to 5 years from now. Okay. Obviously, communicate these changes to us. There are any changes in your portfolio objectives or your constraints, because then we can rearrange the portfolio. Remember, we have close to 30 different portfolios, and so we can always find the right combination that makes you feel comfortable and really balances out your risk on and your risk off appetite. Again, what are we going to do? We're going to just manage cautiously. We're not trying to overthink things. Again, we get signals that say we should go to cash. We get signals that say we should get invested again. And those are bouncing around. And so we don't want to chase our tail. We don't want to chase those signals. We do have to be patient. We do think that the markets will be higher, 3 to 5 years from now. So we don't want to try to overmanage. And we are holding high quality companies. And so sometimes you just have to let those CEOs do their job, run the company, and manage through the crisis, manage through the geopolitical risks. And so we have high quality companies. We don't have companies that are high beta and no earnings. So we have quality companies, and we're very happy with the way the portfolios are positioned. So we're continually monitoring and adjusting as necessary. And then we hope to communicate with you as much as possible. We don't want to over-communicate. We don't want to under-communicate. And, we want to take opportunities like today to share what we're doing. So for right now, the focus growth, 50% cash, 50% invested, focus value and dividend. Those are portfolios that remain fully invested for the most part. The sailboat portfolios, we're shorting bonds, we're shorting equity, we're long bonds, we're long equity, and we have cash. So we're staying very dynamic in those portfolios. So again, all the portfolios are following their mandate. If you have any more specific questions, please let us know, and we'll be happy to go over those with you. So anyway, again, just a quick update, not a lot to share because not a lot has changed, but again, we're going to continue to watch that inflation number, the Fed, the interest rates, and corporate earnings, and we'll adjust as appropriately and or the best we can, and we'll keep you posted. So again, thank you so much. We really appreciate it, and we'll talk to you soon. Bye-bye.